Apple is currently being valued at around 5 trillion. It also trades at a forward price to earnings at around 37. And despite Apple being one of the most profitable companies in the world, I am not buying the company at this valuation. And this is not because Apple is a bad company. The financial results show a strong business. Revenue is rising again, profit margins are expanding, earnings per share are growing as well. But the price investors are being asked to pay right now is extremely extended, at least when compared to Apple's longer term growth. And that is the problem. Let's begin with the positive side. Apple's latest 12-month revenue is around 440 billion, and that represents growth of 12.8%. We can see that gross profit reached 260 billion, while the gross margin increased 48%. Operating profit therefore reached 147 billion, with an operating margin of 32.6%. And then net income raised to 122.6 billion. So these are exceptional numbers, and Apple is definitely not a declining company. The results clearly show improving revenue, we can see stronger margins and rising profitability. The problem becomes clearer when we look beyond the latest 12 months. Apple generated approximately $394 billion of revenue in 2022, fiscal year that is. In 2025, revenue was approximately 416 billion, and that means Apple's revenue increased by around 5% in total across 3 years. Annualized, that is less than 2% per annum. During that period, annual revenue growth was negative 2.8%, in 2023 that is, then in 2024 only 2%, and 6.4% in 2025. The latest acceleration to 12.8 is very encouraging, but investors are already paying a valuation that appears to assume that this strong growth will continue. So the question is whether the latest acceleration represents a durable new growth phase or merely a strong period following several years of moderate or limited growth. Apple's diluted earnings per share increased from $6.11 in fiscal 22 to around $7.50 in 2025. Over the latest 12 months, diluted EPS reached almost $8.30. So that is much stronger than the company's revenue growth. And part of this improvement comes from stronger profitability. We can see that Apple's operating margin increased from almost 31% in 2022 to 32% in 2025. And then we had 32.6% over the latest 12 months. But another important factor is the declining share count. Apple had just under 16 billion shares outstanding in 2022. By fiscal 2025, that had fallen to under 15 billion. Over the last period, it declined further to 14.7 billion, and a lower share count means that the company's earnings are divided among fewer shares, so it helps earning per share grow faster. And that is good for existing shareholders, obviously, but it does mean that we should distinguish between growth in the underlying business versus an artificial growth in earnings per share. Apple's forward PE is currently around 37 times, depending on the displayed calculation, of course. The historical chart shows that this is near the highest level Apple has traded since 2020. For much of that period shown, we can see that Apple's forward PE remained in the low mid-20s to low 30s. It briefly reached similar levels around September 2020 and again moved toward the mid-30s in early 2025. But the current reading of 37 is at the very top of the displayed range. A premium valuation does not automatically mean that the stock must fall by any means, but it means that the company has very little room to disappoint people. The other valuation ratios reinforce the same conclusion. Apple's trading PE is almost 41 and its 5-year PEG ratio is 2.71. Price to sales is at around 11 and enterprise value to EBITDA is around 31 times. None of these ratios proves that Apple will fall. I don't know if it will. Premium companies can remain expensive for longer periods of time, and we only have to look at Tesla for that. But they show that the market already expects an extraordinary level of quality and future performance that we might not get. Seeking Alpha's consensus estimates show Apple's PE declining from around 45 times earnings in 2025 to 26 times estimated 2029 earnings. But that decline does not automatically mean that the stock becomes cheaper. It assumes Apple successfully delivers the expected earnings growth while the share price remains around its current level. and using the current share price of around $340, then the 2029 valuation implies consensus earnings per share of roughly $13. So let us consider several possible 2029 valuations. At 20 times earnings, Apple would be worth approximately $263 per share. At 25 times earnings, the price would be approximately $329, and then at 30 times, it would reach almost $400. At 35 times, we would see Apple share reaching $460, and that is the precise reason why I'm not buying Apple. Even if analysts are correct about earnings, then a return to a more ordinary multiple of the company at historic times would leave the stock almost unchanged by 2029. In order to generate a strong return, Apple must both deliver expected earnings growth and continue trading at the premium multiple. And that may happen, of course. But at the current price, I don't believe the potential return provides enough compensation for the valuation risk.